Well, welcome everyone to The Way It Is. I'm your host, Luca Andolfatto with Remax Service First Realty. And today's a bit of a homecoming for me, actually. Pretty excited to have Brian Matthey. I've known Brian with the Mortgage Professionals and his son, Chris. And Brian and I go as far back as since I got into real estate and since he probably moved to Kingston to do mortgages. Because, Brian, I remember when we were doing way back when the MLS meetings at the ballroom at the Ambassador. And you were there as Coulter Financial at that time. So
that's a lot of water under that bridge, boy.
There's a lot of water under that bridge. So I'm going to do a little bit, just give the listeners a bit of background. So the Mortgage Professionals, if you're in Kingston and you've dealt with mortgages, I'm pretty sure you've heard of the Mortgage Professionals. They've been around since 1989. And actually currently the largest independent mortgage brokerage company in Southeastern Ontario, 32 brokers and agents, and support staff processing over 350 million in mortgage volume each year. So pretty significant numbers. And in fact, in February of this year, they were recognized in the industry as Ontario Brokerage of the Year at the Mortgage Awards of Excellence. So kudos to you guys and congratulations.
Thank you.
Brian, just a little bit of background on Brian. You spent 16 years with major chartered banks in various management and credit roles. And then you started, basically, you're one of the principals of the Mortgage Professionals in 1989. And now you've been doing it for 32 years.
Yeah,
right?
A long time.
And Chris, following in his father's footsteps, you've been a mortgage agent since 2005. And then 16 years as a mortgage broker in the industry. So lots of good experience and obviously lots of lessons learned and lots of good mentorship there. So welcome, gentlemen. And it's a pleasure to have you here today.
Thank you very much.
Thanks, Luca.
So, of course, most of my podcasts this year, since this thing has started, and this is going to be episode 17, which is incredible in itself. But of course, everything's pandemic centric these days. You can't avoid it, obviously. So what I guess we'll do is I'll let you guys just sort of dive into what you see happening in the marketplace vis-a-vis rates. You can speak to fixed rates, variable rates, will they go up? I'm just going to let you guys sort of take over and have those comments and conversation. So,
well, Chris, do you want to start maybe with a little? I'll fill in the background of sort of interest. I've been around, since 1989. So I've been through recessions, recoveries, just about every economic factor that you can think of. Starting in 1989, 12% interest rates. Luca, you'll remember those. Incredible when we think of it. And everything in interest rates revolves around what's happening with the economy. And COVID has probably been the most significant because it's not a regionalized thing. It's not a Canadian thing. It's a worldwide thing. So when you look at interest rates, 5 years ago, I'm talking to clients now renewing them, saying, who would have thought 5 years ago you had a rate of maybe 2.69 and you thought, wow, that was fantastic. And 5 years down the road, I'm talking to them saying, well, maybe we'll be at 3, maybe we'll be at 4, maybe we'll be at 5, who knows? But, here we are and 5 years later, and rates have just had a little jump, and Chris will talk about that maybe in just a minute. But, here we are with sub 2% interest rates. Yeah. And I think the biggest factor for most people understanding interest rates is people see the press talk about Bank of Canada increases interest rates or decreases interest rates, and they think immediately that their mortgage is going to be impacted. The Bank of Canada affects really variable rates only. So we've seen the Bank Canada Prime come down significantly. That affects lines of credit, variable rate mortgages. And we're at 2.45 now, and the Bank Canada said, we're not going to see rates increase until 2023. And the reason that rates would increase is because there's inflationary pressure. They use that basically to control. They don't want to see any more than 2% GDP. So anytime you see that, that's where they're going to react. But I mean, our economy is nowhere near recovering. Yeah. So, from a variable standpoint, they've sort of come back into vogue in the last little while because for the last couple of years, variable rates and fixed rates, there wasn't enough of a spread between you can get a discount on a variable right now, probably 1%, you'd be 1.45 on a variable, and that would apply to, the high ratio or conventional mortgages, and the fixed would be somewhere around close to 2 right now. So you've got enough of a spread in there. But fixed rates are always determined by what happens in the bond market. And we've had unusually low bond market rates. I mean, unbelievable bond market rates that we've had for the last couple of years. Now we've seen a slight increase in that. And Chris, maybe you can. We had a discussion about that yesterday.
I think that's the biggest takeaway for people listening to this is what to watch in terms of what's going to signal kind of that increase in interest rate. And really, if they just pay attention to the activity between the stock market and the bond market. So just think of all these people out there that have money they want to invest, or corporations, money that they want to invest. When things are good, things are rolling. Obviously, people want to be involved in the stock market. It's a higher rate of return. Granted, it's a little bit riskier. But when things are good, things are healthy, that's where their money is parked. Then all of a sudden, and they're taking money out of bond to go into there. Then when we see some inconsistencies or we see some problems, people take that money out of the stock market because now they're losing money and they're going to park it back into the bond market. So bond people sit there, and I mean, this is really oversimplified, but they sit there saying, hey, why are we paying 3% on our bond to our investors when we've got all this demand? We can drop it to 2%. So we see that bond rate drop, and now all of a sudden there's this huge spread because lenders, all they do is they take that bond rate and they have their spread above bond. So let's just say that's a percentage point. Again, we're just going to oversimplify it. Well, now all of a sudden, if they've dropped a whole percentage point, now we've got a 2% spread, so they can just reduce their fixed rate accordingly, right? And then the reverse is true. When we start to see things improve, they leave the bond and go back to the investment or to the stock market. And all of a sudden, the bond rate goes from 2% to 3%. Again, those bond people want to attract that money back. And when we see that exodus and into the stock market, that's when we see that spread on bond to fixed rate kind of being impacted. And that's when the lenders jump or increase their fixed rate because their spread is impacted. Yeah. So that is one thing that people can look for to get an idea. And what Dad was talking to in terms of, we're not out of the woods yet and et cetera, we really have to see what this second round of shutdown is going to do to the stock market, to the economy in general, because when we see these significant economic events happen, it's a good 6 to 12 months before we see its effect on the economy in general. And we've even heard whispers of a third lockdown coming, and that's going to have an effect as well.
Yeah, and I'll just interject here for a minute. I mean, bring it back to sort of real life in terms of, day to day and what you experienced. I mean, I had a call yesterday with a prospective buyer in law enforcement, relocating to the area and, talking about trying to buy in this market. And, I've had this question probably almost every day for the last 2 weeks. So this is a bubble, right? When's the bubble going to burst? And I'm saying, get that word out of your vocabulary. It doesn't exist. It's not a bubble. And, to your point, Brian, the trends, first from a real estate perspective, which I've mentioned on other podcasts, is scarcity of inventory. And that's a trackable trend that's been going on for the last decade, maybe even before. And the pandemic has simply exacerbated that. That's what's happened with that. And it's even worse now. But, to your point about the economy, we don't see it visually ourselves in our areas because we're dealing with a different aspect of it. But there are people that suffered during this pandemic. Pandemic's been the best thing to happen to real estate and presumably to the mortgage market as well, given that everybody's either refinancing or buying up or whatever. But you're right. There are people and businesses in manufacturing or whatever that have been significantly hit. And let's face it, the governments have, I think, in my opinion, they can't raise rates. They can't put even more people out of work or out of their homes. The government doesn't want all these houses back if the rates all of a sudden jump to 5% or 6% or 7% or anything like that.
Yeah. And that's the interesting thing is that this recession is unlike any previous recession. You've heard people or you've heard takes on, this is like the Roaring twenties or the World War II recovery, but this is very different than any other one because this was a worldwide economic event. But the biggest difference is before households had savings. Households had money to put back into the economy. We even look at the last recession in 2008, 2009, et cetera. The government ran up such a tab, they ran up such a deficit because they were putting all their money into infrastructure, et cetera, to keep the economy afloat. And eventually they turned that tap off and they said, what's going to help us now is consumer spending. And consumers in Canada did a fantastic job of spending. And that's why pre-COVID, all of the news was about household debt, right? The statistic was for every dollar of income, there was $1.73 in debt. Now, this includes mortgages, of course, but it also includes outside debt like credit cards and lines of credit. And the government was incentivizing Canadians to spend with all of these rebates, right? You buy a new furnace, you fix your windows, you do this, you do that, we're going to give you these rebates. And consumers spent their money. Well, pre-COVID, all these people had racked up a ton of debt. There were a ton of households that were very close to going into the red. And then COVID hit. And now we had people with high debt and now income disruption, right? So now a number of people weren't affected, but there's a whole lot of other people that were in fact affected. So there aren't the savings or pent up cash flow that we have experienced in previous recessions. Sure, there are people that are hoarding money out there, and sure, there will be some spending because people will want to get back to norms, but not to the extent that we have had previously. And none of us are economists, but these are takes that are out there. So we really have to be cautious as to, is this really now this first little rate increase a sign of things to come? Well, it could just be kind of a false signal, and we could see things step back a little bit in terms of another rate drop based on problems in the economy.
So that's a good segue then, and because I'm sure you get this question 100 times a day, is do I lock in? Do I lock in for 5 years? Do I lock in for 10 years? Do I take that consistency of a fixed payment or do I play the variable rate game? So
I think there's two trains of thought there, Luca. Certainly for first-time homebuyers, it may be much higher at risk. They're probably going to look more so for the fixed rate because they've got some guarantee of that. But those people have conventional mortgage or lived in their house or who are refinancing. Over the last couple of, I've been a variable guy for 20 plus years, but over the last couple of years, because the fixed has come down closer to where variable is, I've talked to people and say, if you can risk it, go variable, but if not, take the fixed. Whereas now, with those rates jumping a little bit, the spread now between variable and fixed is more significant than it was before. And the aspect of variable for most people is you can go in right now, say at 1.45, and if the Bank of Canada doesn't raise rates for 2 years, as they say, and fixed rates are comparable to around 2% right now, you get a 55 basis point spread. That means the Bank of Canada could go up by 55 basis points and you'd still be where you are if you locked into a fixed. Right. So overall, the gamble in the past on variable, which proved very, very good for a lot of people, was they could take the variable, lock in later down the road, or even if they took the variable and by the time they looked at it, rates had gone up with Bank of Canada, on average over their term, they may have been at a lesser rate than they would have on the fixed. The other aspect of a variable is the penalty in a variable is normally 3 months interest at prime. So if you're going to do anything down the road, you've got a more flexible product than you may have in a fixed, because the fixed is normally based on 3 months interest or loss of interest. Now,
yeah, that's a great point, because we've seen a lot of media turning their attention to penalty. People who are trying to take advantage of getting out of their current high rate into a lower rate. And because the penalty is so high, it's prohibitive, people are looking at 16, 17, 20,000, whatever the case may be.
I've heard those numbers. Yeah.
To Dad's point, the variable is just 3 months interest. So it's a really flexible product in that it allows you to lock in at any time, or it allows you to break it at such a small penalty. And the other thing, a great strategy that Dad introduced years ago and that I've been using is, if somebody's coming in and they're prepared to go with a fixed, but they're also considering variable, they're prepared to go fixed 2% or whatever the case may be, but they're also entertaining variable at 1.45, well, take the 1.45 and then set your payment as if it's the 2% fixed. So for the 2 years, while prime does not increase and it stays at 1.45, or the 3 years or whatever, you're putting all of that difference away against the principal of your mortgage, saving you thousands and thousands of dollars on interest.
Good point. Excellent point. And just so I'm clear, and so we can clarify for the listeners, the variable rate changes every quarter, correct?
No. The Bank of Canada sets their rate 8 times a year.
Okay.
8 times a year, the Bank of Canada looks at the economy and says, okay, we either need to boost rates because it's inflationary, or lower them, okay, because the economy is really in trouble, or we stay where we are.
Right.
And I mean, right now they're in this stable position because there's no inflation in the economy, albeit in the bond market, they thought there was going to be, because the bond market signal for the rates to go up in the last few weeks were, okay, we're in recovery stage now. The vaccine's coming out. This is it. Things are going to, really creep along a bit. And as Chris says, we don't know. It might have been a false signal. It could have been just a jump, in those rates. So when you look at it, you're making a gamble in some sense, but you're making a really good common sense decision based on what's happening in the economy. I think the other thing that Chris and I see a lot is people. There's not a lot of there is disclosure, and our industry discloses more than anybody else. We're required to by the government, but there's not a lot of disclosure out there, perhaps in the banking world, as opposed to penalties.
Right.
A lot of people have been caught down the road when they didn't understand how their penalty was calculated. And as Chris said, we've seen people, and the other thing, cashback mortgages, same thing, where, people have been getting cash back and they get a nice check when they close and think that's a great deal. And then 2 or 3 years down the road, the lender says, oh, well, you're going to change? You're going to do something? You got to give us 100% of that cash back.
Yeah.
So there's no free lunch.
And to Dad's point about the Bank of Canada coming out 8 times a year, well, we went from February of 2010 to May of 2015, where the Bank of Canada came out and said, we want to change prime, but the economy is in no place to change prime, so we're keeping it as is at 3%. So that was 8 times a year for 5 years, where they kept it status quo. And then in May of 2015, they dropped it. And then in July of 2015, they dropped it again. So it just goes to show that, yes, there is a risk in the variable, but there are periods of time where it remains, as stable as the fixed in that sense, right? So,
yeah. Okay.
Luca, you talked about the economy a couple of minutes ago. And another thing I don't think people realize is that housing is the major driver of our economy right now.
Absolutely.
You think of all of the things that fall on the side of a house purchase or a house sale or a moving, and you think of all the things that are involved in that. If in the recession in 2008, and basically the market shut down, our economy was impacted by the fact that people weren't buying homes. Yeah. And so you didn't have all of these other services and all these things that relied on housing as a major driver. And right now, I mean, the prices have gone crazy because of the shortage, but it's a major driver, an economic driver, even though we're in a situation right now where COVID is impacting so many.
Well, I'm doing some new home construction with a custom builder of mine, and, a sheet 8x4 sheet of sheathing, or, and it's not tongue and groove plywood, and it's not Aspenite, it's the one in between or whatever. I think 2 years ago it was $8. Now it's $60 a sheet, cut lumber, linear cut lumber, 2x6s, 2x10s, $32 a linear foot. And go and try to order a hot tub or a pool now, or patio furniture, or, you're waiting months.
Even the wood for a deck.
Yeah, exactly.
It's crazy. And, when we're talking to people and they're looking about new homes, or they're saying we want to build, and they have this idea that it's going to cost them X number of dollars a square foot. And we open their eyes a little bit, because the days of $200 a square to build, that's history. That's absolute history. And the cost of new builds has increased, probably tripled in the last probably 2 to 3 years.
Well, builders, not to diverge too far off path, but, builders are doing the same as regular homeowners now. They're actually holding offers on inventory to take multiple offers on existing inventory that's not even built yet. So think of this: if you get in the queue now, the earliest you're going to get delivery of, and I've checked them all out, is probably sometime in the spring or fall of 2022 before you're going to get occupancy. So that's going to segue into qualifying for a mortgage now, right? So in a previous podcast, I talked about, because I know a while back the government introduced the certain requirements, right, where you had to qualify at the higher rate, but you could take the lower rate. So maybe you guys can just chat about where qualifications are now, what the changes you're seeing, are they more stringent, those kinds of things.
Yeah, it's definitely getting a lot tougher for first-time home buyers entering the market. So there's a few different obstacles that they're facing right now. One that you alluded to, which is the stress test. So we're looking at qualifying them based on a rate of, almost 5%, and then the rate they come out with is 2%. But again, they're qualifying at, nearly 3 points higher. Also, when it comes to outside debt, again, we talked about household debt earlier. It's rare for somebody not to have lines of credit or credit card balances. And when it comes to those balances, their report every month or their statement every month might say their payment is $100 on that $10,000 that they owe. Unfortunately, when in our industry, we have to use a 3% payment. So that $10,000 that they owe, we have to use a $300 charge per month that goes against the ratios. So it's a huge difference.
Yeah.
And then, of course, then the other aspect of this is the fact that, we're talking about housing prices skyrocketing, but what's happening with income? The short answer is nothing. Like, it's stagnant. It's not going up. There's COLA, right? They might be going up incrementally each year, but their income is not changing drastically. So we're now seeing less and less people being able to enter the market because of the average house price is way beyond their means. One potential solution to this that we're seeing is more and more common is kind of this multi-generational buying, where you have children going in with, the children of parents going in with their parents to qualify, right? Their parents being co-signers.
Yeah.
And so Dad and I spend a lot of time talking with parents as to what's involved in being a co-signer. And one really great thing that's available through a couple of our lenders is what's called a co-borrower release clause, where the parents go into the deal and the assumption is that they're going to be on there for at least the first 5 years, right? The first 5-year rate until they can get off. But with the co-borrower release clause, they can look at after the first year, second year, third year, whenever, to see when they can be removed from it. So once the children are in a position to qualify themselves, the parents can then apply and the children can then apply to be removed, have the parents removed from that mortgage and from title. And so that's a great clause that we see because it provides the flexibility for the parents to get in, help them qualify. Once the children's income is to the point or their debt load is low enough to the point where they qualify on themselves, the parents can then be removed from that application.
I think the other thing behind that, Luca, and I have the discussion with parents about this all the time, with you now having to report the sale of a home. Yeah. Every time you do it, there's always some perceived tax liability down the road in terms of a capital gain. Now, the kids that own the house, they're tax free, but if the parents are involved, there should be a way, and we counsel the parents on how to avoid a future problem with CRA, so that they know that when it's sold, that they're simply there for the purpose of allowing the kids to qualify.
Yep.
And I think that's an important part of it. And also the parents understanding what their liability is going forward, because it's not to be taken lightly. It's going to impact them. But as Chris says, a lot of these kids don't have a choice. I mean, you and I know, Luca, buying a semi, a couple of years ago was $250,000. Buying a single at that time was the dream home of, 350, somewhere around there.
Yeah.
And I've seen, you tell me, what have you seen in semis and singles lately?
Semis are cracking, depending what they are and where they are, between $450,000 and $500,000 now, whether it's 2-story with a garage or an elevated bungalow style. The singles, I won't say the junk, but the stuff that's dated, needs work, that, sometimes you'd get those mortgages that were purchased and improved because you wanted to update the kitchen or the bathrooms and stuff. They're cracking 500,000, right? Something like that.
That puts these buyers too in another situation, because the government requires 5% up to 500,000, but then they require more than that when you jump over the $500,000 limit. So they have to put 10% of the balance over 500,000. So it's not such a big jump, but it's another thing that the government, has in place. The government brought out a program to help first-time buyers, with a grant. And again, unfortunately, as Chris says, some of these programs, they sound really good, but there's the limitation on buying a home in price was basically 4 times income.
Yeah.
So, you get a couple that are making 80,000. The limitation on qualifying for that program was 320. What can you buy for 320,000? Now they've upped that a little bit, but still, what happened was the market outstripped that program, outstripped it completely.
So, I mean, you're seeing it obviously, and we see it. Have you had appraisals come back that don't meet multiple offer, like a winning bid from a buyer that's trying to buy a place? I mean, that's now 100,000 over or 120,000 over,
Personally, luckily, I have not. I know it's out there. What's been happening is a lot of these times the offers that are going maybe up to $100,000 over. Well, the house down the street also went for $100,000 over, right? Of course, you never want to be the leader in that. Like, you don't want to be the one paying $200,000 or $300,000 above. I know there was one recently like that. So I personally haven't seen it, but I know it's out there, and that's one of the huge risks of people going in unconditional. I know we're going to talk about that.
Yeah, well, and I've heard from a couple of appraisers. I think. And to justify values, they need like a 90-day snapshot. If you can get sales that are comparable within 90 days, and fortunately, like you said, Chris, maybe to your point, fortunately, the market's been brisk enough, or there's been enough sales that have jumped, categorically over asking, that they can draw from that. But
I think,
yeah. So,
sorry, I think, Luke, on the conventional side, it's very applicable, but even more so on the insurer side. When you got less than 20% down, it has to go to the insurer. Now, I've only seen one recently, but I've heard, a lot. You hear the undercurrent about CMHC or one of the insurers saying the market, and they're always commenting, the market's overheating. So when you're going in with, say, 5% down, we haven't seen it as much lately, but I mean, that could be something that could impact something down the road. If CMHC says the place was listed at 400, you paid 525, we're only willing to insure it for 450. That's what we think the real market value is, and you have to come up with the first 75,000. Yeah. So it hasn't happened yet, but you never count anything out. You got to play from a position of caution all the time.
Yeah. So I just got a signal that we're coming to I'm enjoying this conversation, but I don't want people, if they're driving in their car, we don't want to make this an all day thing. But I guess I'll throw it out to you. Maybe some closing comments, some closing recommendations, just some insights that you can offer the general population.
Yeah, I think my one that I would want to hit on, we touch on it, but unconditional offers. When we sit across from a client, they feel the pressure to go in unconditional. That's the way that they're going to get the house. That's just the norm now, unfortunately, in Kingston. Yeah. And me personally, I would never recommend going unconditional. I get it. I understand it. And I know that's the way that they're going to buy a house. So my job is only to outline the risks involved in doing so. And they're extensive, so I can't go over all of them. But they have to understand that when they go in unconditional, that risk falls upon them. And anybody sitting across the table saying, yeah, sure, go in unconditional, no problem, they either don't know what they're doing or they're outright lying, because half the approval is based on the clients, but the other half is based on the property itself.
Yeah. And Chris, and great point. And I'm sorry we didn't get time to really flesh that one out. But I mean, I have these conversations every day, and Brian and I have done this a long time, and I think we operate the same way. I lay it all out. I say, like, listen, here's the reality. You got to deposit with your offer. Here's your closing date. What this means is you got to come up with the rest of the money somehow on closing day. So you got to figure out where that's coming from, whether it's qualifying for your mortgage, getting it from, down payment wise, getting it from family or whatever. But that's the thing. You sign, you get it. You're on the hook. You got to show up on closing day with the rest of the dough, right? So, yeah.
Let me ask you one question.
Yeah.
Are you seeing, there's all sorts of cash buyers out there. So cash buyers, A, are either taking the risk, or cash buyers are coming in from out of town with a lot of money who've sold maybe in Toronto or some other place, have a whackload of money, or going in and looking at a house and saying, that's 500, but I want it.
Yeah.
So I'll pay them 6 because in Toronto, that was $1 million.
Yeah.
Are you
It's
seeing that?
Absolutely. Brian, I sold a house on Cataraqui Woods Drive a couple of weeks ago. Out of the 16 viewings that we had, 8 of them were from realtors in Ontario as far away as Hamilton, Niagara. Okay. With their people in their car while they were still in lockdown, coming to Kingston to show houses. Okay. Now, and this is my little pet peeve, just because we're licensed to sell everywhere in Ontario doesn't mean you should sell everywhere in Ontario, right? So, but you're absolutely right. A house for $550,000 here in the GTA isn't even getting you a semi. You know, it might get you an 800 square foot studio condo somewhere or something like that, right? So, absolutely.
That's what buyers are facing. And again, it's really unfortunate because we see the buyer, we can have buyers that are exceptionally qualified, but we cannot issue the CMHC insurance number. We can't issue the approval. So, we can tell them everything. We can give them every hope that we're going to take every step to make sure they're going to get approved. But I mean, that's the nature of the game. That's where we're playing.
No, and I appreciate it. And gentlemen, I want to say thank you very much. Anyone listening out there, the mortgage professionals, you can find them online. Obviously, they come with great credentials, and they, as you've heard, you're going to get the straight goods. So I really appreciate your time, gentlemen. Thank you so much, and all the best going forward.
Thanks, guys. Thanks, Luke. That was great talking to you.
Good seeing you.
All right. Bye-bye.